By all indications, an economic downturn arising from the coronavirus outbreak is already taking shape.
All of the disruptions caused not just to supply chains and manufacturing, but to domestic demand in so many countries on a rolling basis, it's hard for us to conclude anything other than we're already in a global recession.
As COVID-19 cases rise rapidly and governments work to contain the outbreak, economists say its economic impact may be felt for the rest of 2020.
A milder global recession could be anything below, say, 2.5% global growth, as we saw, for example, in 2001, around the time of 9/11, or if you go back to the global growth number around the time of the Asia financial crisis of the late 1990s. This, for the global economy, is likely worse than that.
The U.S. could easily be down to basically close to zero in terms of growth and could end up in a technical recession. Europe is more likely to fall into that category because of manufacturing and tourism. Both are most heavily affected by the virus and are very important to the European economy, less important to the U.S. economy.
Aggressive policy responses that help liquidity in the financial systems may help avert a global growth contraction.
They are doing everything they can to make sure there isn't a credit crunch. Because the first implications of the virus, of course, are significant shutdown in businesses, in travel, and people are spending less. And what this means is that businesses will run into difficulty with cash flow. And so they need credit in order to ride out that period of difficulty, or else there's a danger of increased bankruptcies.
The global impact of the outbreak could range from 77 to 347 billion US dollars. That's according to estimates by the Asian Development Bank. And outbreak epicenter China will likely bear 2/3 of the impact.
Q1 of 2020 was the worst point for China. We've seen that from the January and February data. As a result of the downturn in Q1 being so large, we have actually ended up needing to revise our forecast for full-year China growth down to 4%, which is the weakest that we've seen in the last several decades.
But even as monetary policies offer an economic cushion, some say there's a risk they may prove ineffective.
During the global financial crisis, that's exactly what happened. Global central banks pump in so much liquidity, but unfortunately, the commercial banks are not lending out. So the liquidities didn't really get to the ground. It really didn't trickle down, to the companies that require all this liquidity.
Experts agree that more targeted stimulus measures are needed to shore up economies from an impact that could be worse than SARS and the global financial crisis.
The economic costs will definitely continue to rise as more measures are put in place to restrict, people traveling from point to point, restrict trade flows and investment flows. Some policy measures has, in fact, backfired. It has stopped more panic and fear than calming nerves.
An open economy like Singapore won't be spared and could sink into recession, with the services sector taking the brunt, says DBS.
The extent of contraction could be as steep as about 2 percentage point decline in terms of our overall GDP growth in the first quarter of the year. And this could spill into the second quarter as well. So we are expecting also a negative growth in the second quarter.
DBS expects the government to roll out more for a second stimulus package.
It's going to be even bigger than the first support package. On top of that, I think the government will draw upon the past reserve. Now, drawing upon the past reserve does not necessarily mean that the government will deploy that fund. That reserve could serve as a contingency fund should a third stimulus package is required.
Apart from the enhanced measures to bridge funding for small businesses, economists expect to see Singapore offering support for those affected by Malaysia's lockdown and workers that will be retrenched.
The last time we've had a non-financial crisis moving the markets meaningfully You had to go back to the 1970s with the oil embargo at that time. And the difficulty for policymakers is that the usual financial solutions are not enough and need to be supplemented with meaningful policies that address the healthcare issue directly.
Experts say the discovery of effective treatments or vaccines to contain the virus and slow down new COVID-19 cases will be key to a rebound.
Certainly on the economic front, it's hard to argue that things are going to improve dramatically anytime soon. The next few months will be a tough time for the global economy, for the regional economy as well.
One positive thing is that the virus itself doesn't destroy any equipment or, like an earthquake or a hurricane might. So that means that once the virus is over, and if we're lucky enough to get a good treatment, people will be able to go back to work quite quickly and restart the economy.
I think it's going to be a V-shaped recovery because we are essentially, expecting a huge pent-up demand in terms of global demand, and that there will be this urgency to return to normalcy in terms of economic activity, in terms of businesses. So I think if we do see a recovery in the second half of the year, it's going to be a very strong recovery.
Uncertainties about the COVID-19 outbreak means investment decisions may get postponed further. But with China and some Asian countries seemingly on the road to recovery, experts say they may be the best places to start investing strategically.